So 2025 is coming to a close, and a lot of the stock market gains this year have come from the Magnificent Sevens. That's Nvidia, Microsoft, Meta, Google, Amazon, Apple, and Tesla. So what we're going to do in this video is we're going to look at those companies in particular. We're going to score them using our scoring method that we use on the channel, and we're going to look at some intrinsic values and see, are any of these still worth buying in the end of 2025? Should we hold off? And what's going on here? So we have the sector listed right next to the ticker, and then we have the score. Now, the score is based off of the growth metrics that we use. We use the PEG ratio, the forward PE, the debt to equity, return on equity, return on invested capital, profit margin, revenue growth. That's expected revenue growth for the next 5 years annualized. This is expected EPS growth for the next 5 years annualized. Free cash flow yield and forward PE5 yield. So these last two are a little bit more, they're a little newer. In particular, this forward PE for the next 5 years. So what we do is we project the PE ratio with the expected growth for the next 5 years. So in other words, when you buy one of these companies, what's the PE now? So I'm sorry, if you buy it at the price right now, what's that PE going to be in 5 years? So for example, the forward PE of Apple right now is 32.2. At today's prices, you're actually getting it for $21, or you're getting it at a PE ratio of 21.29. Okay. So just like the PEG ratio, just like the forward PE and the trailing 12-month PE, the forward PE for the next 5 years, or in the next 5 years, is lower the better. So we see the Magnificent Seven here, and we can see the scores. And if you're new to watching these videos, we like scores of 5 and above. So the scoring system that we use here scores these companies between -10 and +10. -10 is absolute garbage. 0 is, fair. And then 10 is perfect. And we like to choose things from 5 and above. So we see that brings us to 4 companies. That gives us Nvidia, Microsoft, Meta, and Google. And we've ranked them and sorted them accordingly here. And you can see why Nvidia is just so fantastic. If you look at this line right here, they have the best PEG ratio. They have one of the best forward PEs. They have basically no debt to equity. Their return on equity is 107%. Return on invested capital 72%. The profit margin is high at 53%. Revenue growth is expected to be 30% for the next 5 years. EPS growth 40% for the next 5 years. And all of these are in boldface type. These are some of the best numbers of these 7 companies. And the forward PE, if you buy Nvidia today, you're getting it at a 5-year PE ratio of 8.31. That is a bargain. I mean, if we look at these others, it's the only one in the single digits. So Tesla's not on our radar. It's probably overvalued. It's got some concerns. It got fantastic expected revenue growth, but they're kind of lacking in the other regards as well. In addition to that, so that's the growth score. Now we're going to look at the safety score. These are not really safety companies. You really wouldn't look at these companies and say these are going to be, these have low betas or anything like that. But 2 do have safety scores above 5 or 5 and above. That's Google and Microsoft. So we're going to make note of those. And we can see the safety scores here if we wanted to. Now, we're going to go through the valuation models, and we're going to have to take these with a grain of salt, okay? Main reason is these are very sensitive to the growth rates that we feed them. And if you just change the growth rate by a little tiny percent, you get way different values. So for example, this is the discounted cash flow model. And we have our 7 companies here in the Magnificent Seven. And there's only one that comes up with a base case and a bull case that is intrinsically higher than the current price. So the current price of NVIDIA is $182 per share at the time of recording this. The base case is 184 for the discounted cash flow model, and the bull case is 247. If we average these 3 together, we get an approximate discounted cash flow intrinsic value of $190. And comparing that to $182, that only gives us a 4.2% margin of safety. Now, the others are in the red. They're overvalued according to our chosen EPS growth numbers and our discount rate for the discount cash flow model. They're all in the red, but that's not to say that they're all overvalued, because we also have the Graham valuation model. Unfortunately, the Graham valuation model is in the bear case, the base case, and the bull case. These are all saying that these 7 companies are overvalued right now. Not even the bull cases are above the current price. We average the bear, the base, and the bull case together, and we get the average Graham score. And these are all way overvalued. These numbers might be a little suspect. We're looking at Tesla here, and it's saying that Tesla is between 30 and 40 bucks, but Tesla is currently trading for 455. This is why we don't use any of these models in isolation. So Graham is especially sensitive to a company like Tesla. If we look at a discount or a dividend discount model, none of these companies offers a significant dividend. Yes, Apple and Microsoft and Google and Meta, they do offer dividends, but not enough to really do a dividend discount model. So we're not going to, or dividend discount model. So we're not going to look at those. Now the Peter Lynch model, there's nothing saying that Peter Lynch actually made this, but it's based off of his PEGI ratio, which is price to earnings to growth and yield, dividend yield. So again, bear case, base case, bull case. The Lynch model is not saying that anything is undervalued. It's saying that they're all overvalued. Even in the bull case, the price is higher than any of these, and they're certainly higher than the averages. Okay, now another model that we use, and now this one's like the complete opposite of most of the others, is we look at the PE ratio, we project that out 10 years with the expected growth, we dial it back with a discount rate, and we get these. Now, this is extremely bullish for all of them. We look at NVIDIA. NVIDIA is currently trading for $182. The multiples model is saying that should actually be 787. Amazon is 230. It's currently, or it's intrinsically, according to the PE multiple model, saying that it should be 605. So you can see that these valuations are wildly all over the place, which is why, again, we don't look at any of the 5 in isolation. Instead, what we're going to do is we're going to look at all of them together. We're going to average them all together, and we're going to call that our intrinsic value. So here's the price of these 7 companies, and 4 out of the 7 are they have some sort of intrinsic value with a margin of safety. So NVIDIA is probably close to about $312 according to our analysis, which gives you a 41.6% margin of safety. You always want to bake in a margin of safety when you're buying a stock, right? If you think something is worth $100, you're not going to pay $100 for it, because that $100 might be wrong. Instead, what you're going to do is you're going to buy it for $90, you're going to buy it for $80, you're going to buy it for $70. Because if your analysis is wrong, you may not be able to sell it for $100. You may be able to sell it for $95. So if you buy it for $90, you can still make a $5 profit. If you bought it for $80, you're making even more of a profit. So you always want to bake in a margin of safety. And according to these 5 models, rather not the dividend discount model, but if we look at the other 4 averaged together, 4 out of the 7 companies in the Mag 7 have a margin of safety. Personally, we like margins of safety that are higher than 20. And so that really only has NVIDIA fitting that bill with a margin of safety of 41.6%. Intrinsically, we think that is worth $312. Now, Meta, Amazon, and Google also probably have a little bit of margin of safety to them according to this analysis. But again, we typically like 20% or higher. So in summary, what if you had $100 and you absolutely had to invest it? Okay. Now, the way that I've made this summary sheet is you can invest $100 or $1,000. It really doesn't matter. You would just scale it appropriately. But we're going to assume that you're new to the market. You want to invest $100. According to this analysis, which again, this is not investment advice. This is just for entertainment and educational purposes. But based on the Inner Flame financial research, how would we invest $100? Well, we have the growth scores and the safety scores of the 4 companies whose growth scores were above 5. So yes, Meta and NVIDIA both have safety scores below 5, but we're not too terribly concerned with safety with these 4 companies. We want growth. We want that massive growth, which these companies can offer. So we're looking at the 4 companies that had growth scores 5 and above. We actually averaged their scores together just to see that when we average them, they do have average scores above 5, except for Meta. Meta's almost there, but not quite. We have their intrinsic values that we calculated on the previous tab. We have their current stock price, and then we have their margin of safety. So because Microsoft has a negative margin of safety for the time being, we are going to invest nothing into it, but we're going to look at the average scores, and we're going to look at the intrinsic value and the margin of safety, and we're going to base our investment off of that. So because NVIDIA has such a high growth score, such a high margin of safety, according to these weights right here, we are going to invest $73 into NVIDIA, nothing into Microsoft because it has a negative margin of safety. We would invest $17 into Meta, and we would invest $10 into Google. Again, that's not financial advice. I'm not saying to go run out and invest that money into these companies. But what I'm saying is, according to our analysis, what we would do at Interflame Financial Research is we would invest 73% of our capital into NVIDIA, 17% into Meta, 10% into Google, nothing into Microsoft quite yet. This is if the purpose of our investment was to invest in the Mag 7. So Tesla and Apple and Amazon, we would probably hold off on for the time being. So if you got anything out of this video, if you learned anything, if you have any questions, comment down below. But please like and subscribe. We're going to be coming out with more research of different sectors. We're going to look at different industries. We're going to look at the Interflame portfolio. From time to time, we're going to see how it's comparing against the market. That portfolio is using this analysis and this research in it. So hope you come back. Please like and subscribe. That'll encourage me to make more content. And thank you for your time.